Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Hall Road Investments. In this podcast, I will be providing practical and implementable advice for those looking to build, manage, or service a family office. In this episode, we're digging into family office services.
This is the Family Office Sherpa.
Over the years, I've been engaged by firms such as asset managers, wealth managers, asset consultants, investment consultants, and Big Four accounting to provide feedback and research on how they can attract or service more family office clients. Because invariably, they're looking at this client type and thinking, well, this could be attractive for us. This might be something that we should be looking at. The feedback from the family office themselves is nearly always universal, which is to create a business unit called Family Office Services. So for those looking to build a family office service, it's important to understand the client segmentation first. So let's go through it. And when I say segmentation, so this is not necessarily just for people looking to service family office. This is for those that are looking to use these services. So if you're listening to this as a family office, think about, is this you? And if you're thinking about it from a family office services point of view, think about, is this an offering that we can provide? So they are a client segment unto themselves, but I would say more closely aligned to endowments and foundations than more aligned to retail or institutional. Sometimes they're institutional-like in the way that they invest. A lot of heavy use of private markets, illiquid assets, long-term investors or patient capital, just like endowments and foundations. And they can invest in a lot of different asset classes. There's not the level of compliance burden that you would probably see on retail. And especially if they're at a size, they can get access to some quite idiosyncratic aspects. However, they are more like retail in the way that they make decisions sometimes. Sometimes it's an individual that, has total, control of the way that the investments are made. And they can be incredibly self-directed in nature. They are not institutional structures. So when I say that, I mean that they're not structured from an operational perspective in terms of saying, well, we have a significant amount of resources. We have heavy technology spend and things like that. Particularly in Australia and New Zealand, which is where most of my clients are, they're dominated by Generation 1 and Generation 2. So there's not a significant amount of stakeholders or, members or clients or whatever you want to call it. And also terminology like diversification, risk-adjusted returns and things like that is almost the antithesis of the way that they view their investment style. They've made significant amounts of money by making concentrated bets. That tends to be the way they invest, in particular that first or second generation. Next one, they don't have, like I said, they don't have members or shareholders. The investments can be made incredibly quickly, not necessarily by committees. They're not intermediated heavily by asset or investment consultants like your institutional clients and wealth management clients. Often the investment staff are trusted advisors that have moved over post-liquidity events. So they've built a great business. They've sold that business. The people that have been on that journey with them come over to the family office with them. And they tend to be of similar mindsets to the family. So you do get this continuation of, if we like a particular asset class or a particular way of investing, it will run through when the person running the office is very similar mindset. It's only when we're starting to see that a little bit now, where finance professionals or institutional asset management types come into the investment roles, you'll see a little bit more of an institutional mindset, which can, cause some ructions between sort of the old way and the new way. But ultimately, we are starting to see that, what some people are calling professionalisation. I don't know if necessarily that's the right term, but what it means is it's being more aligned to that institutional, strategic asset allocation as the building blocks kind of mentality. And that can, a lot of the time, reduce that idiosyncratic risk, because they are looking at, potential career risk associated with those heavily idiosyncratic and heavy bias towards specific asset classes. So what else? From the governance point of view, some formal investment policies are not always in place. Part of Hall Road Investments engagements around the investment policy and strategy is sometimes just building one, or there might be previous ones that have got draft written on them, or they might have been done by a wealth manager or someone like that, and they're more aligned to the wealth management product sometimes, not necessarily the family. So a lot of the time I'm brought in to sort of really help the family articulate what their policy and strategy looks like. And often, there are often concerns by the fact that they don't have one. That's why we're starting to see that a little bit more. And it goes back to that increased professionalization, or whatever you want to call it. But it's the acknowledgement that there is a risk there, that if the individual that has a lot of oversight over the portfolio, a lot of that information is in their head. And so, if you're looking to service that type of client, you've got to understand that they're not coming from heavy governance and not coming from long-term strategy. A lot of the reason why they make the money, like I said, is because they made heavy bets with their skill set. Often the values and the expectations of the family drive the portfolio construction and risk, but it's not always written down. Often there is a particular asset class that dominates the portfolio. We see this in particular around sort of things like direct investments into companies. Maybe it's public equities. A lot of the time it's real estate and things like that. Often because that skill set is within the office. And like I said, those outsized returns come from those concentrated bets in specialist knowledge areas. Next one is when, where once the main asset class was determined by, the family office internal buyers, we are starting to see the need for diversification. So this is why, talking about family office services is quite interesting, because what we're starting to see is this movement towards diversification away from that sort of classic investment strategy. And that's outside their comfort zone. Getting into asset classes they might not understand or not have any interest in. And that requires this specialist knowledge that only outside or potentially outside people can bring in, or specialist advisors can bring in. So what used to be sort of the domain of wealth managers and private banks, we are starting to see now this desire to have independent firms that sit as an advocate for the family office rather than your normal counterparty. If the family office has the scale, they can internalize it sometimes, but we are starting to see that going, well, who can we get to help us rather than sort of take over, but who can come in and say, we understand what you're looking to do, and we can use our our resources and deep research and relationships and stuff like that to improve, rather than the old private banking model or the wealth management model, which is not necessarily the same now, but was, we'll look after that for you. Just give it all to us. We'll do it all. We're starting to see less of that. Another big difference with family offices, as you will all probably know, is that they rarely have an established centralized custody reporting. When I say custody, it means, like Northern Trust or State Street or some of those big custodial banks holding all the assets within one structure. That's very rarely the case. Hall Road Investments was a business I started 5.5 years ago. And one of the reasons why is because there was a client that had a custody bank, and that custody bank really wasn't interested in servicing them. They didn't really want them as a client because they were mid-market. And so my first job in this sort of structure or this sort of service was to find a non-custodial tracking and reporting structure. So that's really how Hall Road got started. But that shows you that's where the demand sits, because they don't have that classic all into one custodial reporting. And to remember, if you're looking for the segmentation here, and I'm sure if you're a family office, you recognize this, but the internal staff is going to be the biggest competitor to those service providers, because they are there. They are in the family office, and they have the skill set, and they know, and the family office trusts them. So if you're looking to service this client base, you need to be able to prove that you can add value and over and above the internal people. But also you need to be able to add value in helping them, being able to say, well, all these sort of things we can take on for you. So that's the segmentation. But, not everyone's the same, obviously, but there is homogeneity in the space. So hopefully that's helpful. So again, what is a family office service, Dan? So the terminology. Really, it's a dedicated business unit created with one single contact. If someone says, put me through to your family office services or those who look after family office, that's where it should go to. They're serious. What it proves is a business is seriously aligned to those family office needs. If I hear we have a family office specialist, then that means that they recognise that this is a segment, this is a client type unto itself that's not institutional, it's not retail, and that they're taking it seriously. So if you're looking to build an offering, what are we seeing? Well, what am I seeing in terms of demand? First of all, firms that take a client-focused approach, like I said, have that advocacy mindset as opposed to we are the firm, this is what we do. It's more aligned to what do you need? What are your friction points? How can we assist? The most cited sort of version of this, and that proves that it's more of a client-focused counterparty, is that they are willing to introduce third parties or other businesses that might have overlap or compete directly with that business, but they understand that, if you've read Good to Great and you understand sort of that hedgehog, what are you best at in the world and what are others best at, and being able to be that curator of a great service list. That's incredibly helpful. Admin as a service is another one. So that's becoming really prominent, which is basically those firms that interact with the client the most. So if you own that admin relationship, that's where most of the contact comes from. Investment portfolios require quite high touch. And if you can be that good counterparty that looks after the administration, you're going to be the one that talks to that client the most. Now, especially as we move towards sort of private markets and other illiquid assets, which require more manual intervention. Now, if you can't do this yourself, and again, going back to that scope creep piece, get a firm that can do it for you. Again, back to that curation side, knowing good partners. There are managed service firms that will intermediate things like reporting structures and OCFO and those kinds of businesses around the world. Use them if you don't have it internally. Another sort of good family office service is one that's good at referring into other family offices. It creates a good network effect. I think one of the best value propositions of Hall Road Investments is the fact that I'm really willing to just introduce other families that I know might have gone through a similar journey or might be going through one currently. It's so helpful to have someone that's purely empathetic and saying, we went through that as well. So I'm really happy to introduce other families to other families, regardless of the sort of the commercial component. It's really just, it's just a nice thing to do. Another one is having a concentrated or small team that can be your point of contact for the larger group. The biggest feedback is that from family offices specifically is that we don't want to interact with a large team. We don't want to ring up and not know who we're going to get. We want our central person or relationship manager to be the curator for the rest of the business. If we say we're going with a bank and that bank has one centralized person and they can look after things like as complex as how is the data feed going to go into our reporting platform. I don't want to have to then go to the operations team within that bank and try and figure out who I should talk to get that across the line. Be an advocate, be the conduit for the rest of the bank or the rest of the service provider. The other one is to be alert to the other feedback has been, if you can be alert to opportunities specific to our office, that would be a really big benefit. Just understanding what we're looking for. If something pops up and it's good for us, then that's really helpful. Provide global connectivity and expertise with those people within your firm, especially if it's a global firm, that that might be helpful for us. I see that a lot, big offices saying there is a group out of the US or London or Hong Kong or Dubai or something like that may be really interesting to talk to. I'm really happy for you to talk to them or make that introduction. Or they're going to be in the country. This is a really good opportunity to talk to them. Don't be, again, that gatekeeper of no one talks to this client but me. Don't be that person. The other one as well is, and this is sort of my value prop as well, which is take on those tasks where there's lack of capacity internally and is causing the most friction. There's a great thing to be said for saying to someone, and I'm sure we've always all been in this situation where if someone comes to me and says, that thing that's causing you a massive headache and is causing you to be anxious and not love your job, I will take that on for you. And I will do that because that's what I specialize in. That's a really good service and that's really beneficial. Often that sort of sits within the data and admin heavy kind of components, or it might be low impact but really, really high touch. You don't want to see in the family office sector really highly credentialed people having to do a lot of data entry, because that's how you get turnover. And that was covered in the last podcast around sort of staff turnover and resourcing. Another one is to be wary of is the fact that you're not going to be the only relationship here, right? I think the Gemini Report, and I'll include this in the show notes, but it mentioned that they've moved from 3 relationships per person or per family to over 7. And you kind of see why, which is that, they seem to be going through a method of, well, more is better, or we're diversifying across counterparties and stuff like that. It adds more complexity, but, there's something to be said for it in terms of getting access to other specialists. But wouldn't it be great if you're the curator of that? So that's where we're saying is being a really good service. And I know I'm kind of belaboring the point a little bit here, but being the good advocate and curator of complexity and taking on the burden of all the capacity constraints and things like that, that's a really good family office services offering. So what are we not looking for? Providing an OCIO structure or something similar like that in terms of terminology when it's not. So being clear in the labeling of your service. If you're an OCFO, make sure you're an outsourced chief financial officer, not an investment manager calling yourself an OCFO. If you're providing an outsourced chief investment officer, don't just give me a risk profile managed or aligned model portfolio discretionary account. That's not the same thing. So just be clear. Don't make things more complex, but just make sure you're really clear in the labeling around what service we're getting. Don't continue to give us product all the time. Give us product or services that are really helpful, but that again goes back to the advocacy piece, right? Which is understanding the client's needs and giving us or putting us in front of products and services that will be super helpful, not just because, Barry at head office or Susan at marketing and product has said this is the one we're pushing at the moment because this is the one that gives us the highest margin. Don't be that person either. The other one as well, and this is really important, don't advisor creep. Be aware of your limitations. So go back to that hedgehog kind of component, right? What are you the best at? And telling clients that you can do something when you can't is really detrimental. So because you'll get found out. So be good at what you're good at and be comfortable in that you're so good at that you can improve the client relationship by introducing other firms that can be much better at it. There's a really good article from Edward Marshall from Denton's, and again, I'll put this in the show notes. He wrote an article for Family Wealth Report in which he articulates that he says, don't be the firm that says, of course, we can help with that as well, when you can't, right? There's no single individual or organization can do absolutely everything to support a family, right? And this is what Edward says in the article. It takes incredible discipline, experience, and confidence to admit that, right? So that's what we're looking for. The last 2 here, which is one, don't be super wide in your offering. Be like a good restaurant. If you go to a good restaurant and you see 5 dishes on there, you know that they're going to be 5 cracking dishes. Don't be 144 dishes where you know that half of them are going to be defrosted or sitting in bain-maries. Be that good restaurant. Be a small list of really, really high quality, high standard services that we know we can rely on. And lastly, don't ring fence clients. Don't be that firm that says you can't talk to them, this is ours kind of thing. Even if it's, they're seeking a service or something like that might be super helpful for them. Don't gatekeep. I think the best family office service businesses I know are those that are very confident in what they do and very confident in what they don't do. So, don't be that gatekeeper. Don't ring fence clients. So that's it. If you want more information, as always, go to the website, wholeroad.com.au. You can subscribe to the newsletter. If you're listening to this podcast on Apple and Spotify and things like that, it'd be super helpful if you could sort of, put a star rating against it, but also share it with those that you think might find it helpful. And until next time, thanks for your time.